From a struggling Finnish financial services group to a leading Northern European property and casualty insurer, this is the story of the people, decisions and deals that shape the Sampo Group of today. Welcome to this first episode of Inside Sampo. Despite being named after a mythical mill that brings fortune to its owner, a series of mishappenings caused Sampo to lose its way in the late 1990s. In this first episode, we will hear about the arrival of Nalle Wahlroos at Sampo and the new direction he set for the company. With me in the studio, I have Björn, Nalle Wahlroos, former Group CEO and Chairman of Sampo, and the dealmaker who turned the company around. Nalle has a background in investment banking and is known as former Chairman of Nordea and major shareholder in Sampo. Nalle recently published his memoirs focusing on his years with Sampo. And I am Petra von Rohr, leading this podcast today. So thank you for coming here. So I'd like to ask you, what brought you to Sampo in the first place?
I'm not sure brought is really the right verb. I don't know. I ended up or I was traded or... Anyway, I turned up at Sampo on January 1st or January 2nd, actually, of 2001, as the result of a transaction, of an acquisition. Namely, Sampo bought my private/investment bank, Mandatum Bank, because the board of Sampo wanted to enact a changeover. And as part of that deal, they also wanted me to take on as CEO of the combined group. Now, of course, Mandatum, I think that was valued as 7% of Sampo in that transaction. So in a sense, it was not a merger of equals in technical terms, but of course, the idea behind it on the part of the Sampo board who acted rather than executive management was really to acquire a new management team led by myself in Sampo.
Interesting. So what was the condition of Sampo when you took over as CEO?
Well, one way of describing it is that it was the result of a unconsummated merger. Sampo itself was originally a mutual insurer based in the southwestern Finnish city of Åbo, Turku, that had turned joint stock, had changed status to a joint stock company in the latter 1980s. But it still retained a lot of its mutual spirit in its organization, its management, and in its sort of business approach. In 1999, in a deal where I participated as an investment banker, a merger was arranged or set up between Sampo and the Finnish Postal Bank, which of course was then owned by the Finnish state. And the idea was to create bank assurance with this formerly mutual insurance company and this formerly state-owned bank. Now, I think almost anyone can realize that it was not a merger made in heaven. And as a consequence, Sampo, which has had quite a few problems of its own because of its its history and an insufficient amount of rationalization of strategic work and so forth, actually took on another pile of problems with the postal bank. It was not a catastrophic case, but it was, of course, a somewhat bureaucratic, old-fashioned, state administration-like bank. And what then happened was nothing. So for about a year and a half, and this is why I called it an unconsummated merger, Sampo was basically two completely separate parts, neither of which really did particularly well. And this is where the board decided they needed something else.
What was your initial plan when you entered Sampo? What was your thinking?
Well, the obvious part of the plan is that you had to do a lot of cleaning up. And that was kind of obvious from the start. But then, of course, that was not sufficient. Cleaning up is one thing, but you also need a direction. Looking at the assets we had on the table, which was the old P&C insurer that also had some life insurance operations in the group, the state-owned postal bank, and then my private/investment bank, which was much smaller. I came up with the idea, and talking to some of my colleagues at Mandatum, we came up with an idea to focus this operation on what we call long-term savings. We looked at Sweden, we looked at Scandia, we looked at some other success stories, and we said, let's do something pretty much like that. Let's focus, use the bank's distribution network to start selling savings products, which were underrepresented in Finland anyway. And then let's sort of slowly get out of general insurance over the longer term. Let's get rid of all the completely obscure international acquisitions that Sampo had made. And as I said, let's focus on long-term savings, i.e. asset management, life insurance, private banking.
As the new CEO, what key actions did you prioritize to set the new direction for Sampo?
Well, the first key priority was to get rid of a great number of people at the top level of Sampo. Not just because it was not the most spectacularly competent team that I've experienced, but for the very simple reason that there were way too many executives. Because in not just the one merger we were talking about between the postal bank and Sampo, the insurer, but a number of lesser mergers that had preceded them. One sort of feature had always been that everybody got a new job. And never was that more obviously distracting or even destructive than in the Postipankki-Sampo merger, where actually Sampo came up with a new matrix organization, which clearly aimed primarily at offering a nice executive job for all the guys from all the executive boards around the group. So there were close to 3 times too many executives. So the first thing was to get rid of a lot of these guys. And of course, there's a silver lining to that, because when you have 3 times too many executives, even if they're not all the most fantastic executive groups, you still have a lot of talent there. So if you just manage to get rid of the people who are slightly less talented than the one you leave behind, you actually get quite a good executive team.
So it's a good start.
Well, yeah, there was a lot of work to do, but this was one way of starting.
Interesting. So by then, what was your view on P&C insurance?
It was not just my view. In the year 2000, stock markets the world over took a very dim view of P&C insurance. The market was extremely growth-oriented. Investors were willing to pay very high multiples for anything that grew quickly. That was, of course, partly a reflection of the first sort of IT boom, where, of course, you were pricing growth, nothing else. And that was reflected into the view that the market took of P&C insurance. And I, of course, went with the market and said, this is not good. Our investors do not want to pay high multiples on this. However, they are willing to pay high multiples, I think, for long-term savings. And as a consequence, we downplayed the P&C thing. We did not go all in the sense that we would have clearly stated that we're going to divest it. We said we'll play it on the side, sort of. It's not a strategic focus.
Can you please tell us a little bit about the Nokia disposal? What made you take that decision at that particular time?
It wasn't really that exceptional. If you'd go back a couple of years, just a couple of years from, perhaps even just a year from January 1st of 2001, close to 3/4 of Sampo's market cap was its holding in Nokia. Now, by any normal standards of portfolio management, by any standards of a sort of managing the insurance technical debt of an insurance group, having 3/4 of those funds invested in one asset, any asset actually, is irresponsible. Now, add to that the asset in question had an absolutely incredible run. Over 6 or 7 years, it had doubled every year. And at the top of its run in the summer of 2000, Nokia was Europe's largest companies and one of the largest companies in the world with a market cap north of 200 billion. So it really did not take a Nobel Prize winner in economics to come up with the idea that this is a bit too big for Sampo. So we invited our good friend, the then CFO of Nokia, Olli-Pekka Kallasvuo, to give an investor presentation, we being my right-hand man, Kari Stadig, and myself, and we sat through the presentation. It was a good presentation, but it ultimately didn't turn our head. So more or less the next day, we gave our CIO instructions to sell down the stake. We had about 30 million shares in Nokia. We sold 23 million shares over 6 or 7 weeks, cashing in 800 million euros. The whole position was worth about 1 billion. And of course, it was fortunate because we got about 34 euros a share. And of course, the share is presently trading at 340, and it's 25 years ago. So of course, it was a fortunate move.
A very good timing. So with cash at hand, new opportunities opened up. So how did you think about using this money to further Sampo's strategy?
Well, Sampo was actually, the one good thing was, it was awash with cash even before the Nokia deal, because Sampo had done a couple of very good deals. Again, they were not part of the strategic setup. They were just deals that had been fortunate, one of which I had, or perhaps the best of them, I had the fortune to sort of help with as an outside investment banker. It was a deal that, to a large extent, Mr. Stadig and myself negotiated together. At that stage, he worked for Sampo. I was investment banker. And that was a deal by which we bought a lot of shares in one of Sampo's main competitors, Pohjola. We bought the shares from Skandia, and then we bought some in the market. So Sampo actually owned all of a sudden about 1/3 of Pohjola. And then a lot of things happened, and ultimately we sold those shares at a profit which was almost as big as the profit from the Nokia transaction. So Sampo had more than 1.5 billion, which in those days was way more than it is today. And then back to your question, we were not really in a hurry to spend that money. Although later on, as we proceed in the story, it may seem that way. But it felt good to have a very good big cash pile, and perhaps that pile was really the reason why we then proceeded with an acquisition, which ultimately we did not go through with, which perhaps was not the smartest acquisition in the world.
You were involved in several M&A negotiations during your years at Sampo, and there are some really interesting anecdotes in the book about the negotiations, for example, with Storebrand and Skandia. Perhaps you could tell us a little bit about the interactions you had with Kreutzer and Wahlroos, and perhaps talk a little about the cultural differences in the Nordics.
Well, actually, I don't think there are so many differences in, or at the time, there wasn't that many differences in culture in various insurance companies. Everybody actually seemed to think pretty much alike. Namely, they wanted to get out of P&C insurance and get into the rapidly growing asset management or savings industry. But of course, everybody had their own style, and everybody was very, very dependent, particularly Skandia, of their shareholders. You may remember Skandia had a very weird set of corporate bylaws, which essentially prevented any shareholder to vote with more than 30 shares, which is kind of ridiculous, really, left all the power in the hands of executive management. But of course, the first thing we did really, or the first big deal we started working on, was an acquisition of Storebrand. The initiative was not ours. The Norwegians very much wanted to be acquired, partly because their share price had done well, and partly because they had an executive change with a sort of kind of a pro-term executive team led by Ida Kreutzer, and they really wanted to get to be acquired. They also had 2 or 3 very large individual shareholders, Norwegians, who very much liked to sell their stock because they had basically had a good run and they had a big profit coming in from it. So eventually in the spring of 2001, we negotiated an acquisition of Storebrand, which fortunately was opposed by the Norske Bank, who had acquired 10% of the shares. And so we went on with that deal through summer, and we never got the 90% we needed to get under Norwegian law and normal sort of acquisition practice. Up until July, when Storebrand came up with a really bad set of numbers, which essentially already started us thinking that this may not perhaps have been such a great idea at all. And then, of course, came September 11th. And after September 11th, this was a foregone conclusion. So fortunately, we had a contract which allowed us to basically get out of the deal, and that was back. I was very fortunate. We learned a lot, but in retrospect, we never should have made the bid. But again, we had to pay some banker's fee. But other than that, we didn't lose any money.
Exactly. So some of the best deals are the ones you don't do.
Well, in this case, it's certainly true, and actually, quite frequently, I actually make the point in the book. It's quite frequently the case. It's very important to be able to sort of leave the table if what you had expected to see really doesn't materialize.
Yeah, there are some really interesting parts in the book about that. And the Skandia deal, could you give us some flavor on that? And Wahlroos, the discussions you had?
I didn't have discussions with. I knew Björn Wahlroos from before. I didn't have discussions with him. I used him as an example of how strong the defenses that Skandia had built up. We did negotiate a lot with his successor, Lars-Erik Pettersson, and his management team. This really started out as basically a short-term investment. Skandia share price, you may remember Skandia was one of the great success stories of the Nordic insurance industry, and it developed basically a new product which they called variable annuity. It is essentially an asset. It was an asset management contract that they sold to people who wanted to save for the longer term, basically for their retirement. And it was exactly the sort of product that the market loved, because whoever started saving with Skandia committed to set aside a given sum of money every month, and then Skandia got to sort of manage that money, and they got a fairly hefty cut in it all, and the market loved it. So the share price of Skandia went sort of through the roof. It sort of 10 doubled in a couple of years. It went up to about 250 kronor a share, and it was, to my mind, obviously overvalued. But then it started to come down. There were a lot of things that it was obvious that the product had some problems there. They didn't do that well in the United States. Everybody had expected them to do really well. And then ultimately we got the Skandia scandal, in which you in Sweden so well remember. There were a lot of things that people were not happy with, and Skandia's management were not very good at answering questions, at handling that thing. So the share price kept down and down and down. And when it hit through 30 kronos, i.e. it had lost about 90% of its value, our CIO, Mr. Lappvetalainen, came in and said, look, as I said, we had a lot of cash. So he came in and said, look, I think we should buy some Scandia shares. There's a lot of upside. And he came up with the valuation. Eventually, I told him to buy 1%. Then I went to my board and said, look, we think this is a good thing. Let's buy 5%. We bought 5%. And eventually we got up to almost 9%, which made us the largest shareholder in Scandia. Well, what happened then really was that the Scandia shareholders revolted. And first, the previous chairman resigned. There was an interim chairman put in place. And then ultimately, the AGM of Scandia installed a new chairman who, as his first sort of action, threw out previous executive management, particularly the CEO, Lars-Erik Pettersson. We knew Bengt Braun, the new incoming chairman, very well from various sort of combinations. Particularly, I'd worked for Bonnier, where he was CEO as investment banker, and my colleague Kari Stadig had worked with him in Finnish media business. So we opened up negotiations with him. We started talking a merger. We suggested when Sampo would acquire Scandia. Bengt and some of his advisors were initially very enthusiastic about the idea, and we actually then negotiated about it for half a year, off and on. And we were all very enthusiastic to start with, but then when sort of fall approached, October, the negotiations got more and more tricky. We had looked very carefully. We really did some due diligence. We had some management presentations. And the more we looked at Scandia, the less enthusiastic we were about the savings business. And ultimately, we really lost all taste for it, almost. Particularly since Bengt also started to negotiate very toughly about certain other conditions having to do with corporate governance and stuff. So ultimately, I said no to the deal sort of at the end of October. I'm very sorry, this won't go anywhere. And we left it there. But the one good thing was that during these negotiations, Bengt Braun's, the chairman's sidekick, who was a pro-term CEO of Scandia, Leif Victorin, who is the unsung hero of what later became the Sampo P&C business. He somehow got us enthusiastic about the P&C business. That's not exactly what happened, but it struck both myself and my colleague Kari Stadig how very optimistic Leif Victorin was about the P&C business. He didn't give a hoot about the savings or asset management business, but he was absolutely convinced that you could actually turn the P&C business around and make it a good business. And he was, we did not take his word for it, but he was so convincing that we decided we had to look more carefully at this.
He planted a seed.
He planted a seed and a little more than that. So we started to go over Scandia's P&C business with pen and paper. And the more iterations we did on that, there was just one conclusion. This could really be turned around, and this could really become a big moneymaker if properly run. And that takes us to sort of December. And then we had to change our mind. Mr. Stadi changed his mind early on in the game. I was slower, but eventually we got ourselves in a situation where we could start negotiating about buying what we really wanted, which was If.
Yeah, I think it's a bit too early to leave how you found If. You touched upon that with Bengt Braun and the new CEO who planted this seed in your head. But can you please tell us a little bit more about the steps leading you to If?
There really aren't any specific steps, but I'll walk you through it. Since you're interested. The thing really was that we had, of course, looked at If. We we had become shareholders. We were actually the largest shareholder in If, but we were not controlling, we were almost controlling shareholder. We owned 38% of the stock at the time. And that we had gotten when the year before, in 2002, we sold our own P&C business to If in a very well negotiated deal, which was primarily negotiated by my colleague, Kari Stadig. And then I installed him as chairman of If. So we knew If very well.
Yes.
But we still were not convinced that it was, the losses If made were quite significant. Their combined ratio was north of 110%. So they lost more than 10% on the insurance business alone. And then they didn't have that great an investment portfolio. So they were not really able to recover that money on the investment side. It was just a very bad operation. Plus, of course, there was a lot of under-reserving there because Skandia desperately needed cash. So they had extracted as much out of the company by under-reserving for many years running. So it was a very problematic case if you look at it superficially. And you needed to sort of get behind the superficial numbers to look at the actual business and what you could do to it. Then you needed a first-class management team, of course. And that was what happened in November, December. The really crucial moment, if that is what you're asking for me, because I was not quite convinced, whereas Mr. Stadig was, came in sort of mid-December when we had a meeting with our advisors from Goldman Sachs, a very good team, by the way, Chris Williams and Andy Dodd and others. And I was very worried. I actually wasn't concerned about P&C insurance, but I was very worried about the leverage we would be taking on it, because it was, in those days, a reasonably big deal to do. We would have to come up with valuation 2.2 and 55. We would come up with more than $1 billion in cash to do it. And I was sort of saying, look, this is not, I'm not quite convinced, because either we have to cancel the big dividend we were supposed to pay, which I knew our shareholders would not like, and particularly since Finland was changing its taxation of dividends, it would be a really stupid move, because to postpone that dividend would mean incurring a tax liability. So it was not good. Or we would have to sort of raise new capital by a new issue, which I knew our shareholders would not like either. And at this meeting, Andy Dodd looked at me and said, no, you're wrong. You don't need to raise any new capital. And I said, yeah, what is that? We can't run that kind of leverage. And then Andy Dodd explained to me that when you acquire a P&C company, the capital rules are completely different from banking that I was used to. If you're you only have to have capital against the goodwill that you're purchasing. And I thought that was ridiculous. So I said, oh, man, this is ridiculous, Andy. So I can buy an unlimited number of P&C companies at book, and I need no capital. And Andy Dodd said, yes, that's a great idea. I said, you're nuts. And then he convinced me that, no, that's true. And since we were not playing, we were only planning to pay about 1.15, 1.2 times book for If. This was very, very important, because it meant that the capital we needed was way smaller than I, using my banking rules, had expected. And when I saw that, I couldn't believe my eyes. I said, okay, look, let's go.
Okay, so that was a game changer too.
That was a game changer.
Yeah.
I liked the business case, I liked the numbers, but I didn't like the leverage. And now what Andy came up and said, you're not going to get the leverage.
That's fantastic.
Yep.
And you talk quite a lot about Kari Stadig in the book and the way you work together. But could you also say something about his role to the podcast listeners and how you work together?
Yeah, the one really good thing about originally merging with Sampo back in the year 2000 was that amongst the executives, he was head of life insurance at the time, was a very good old friend of mine. This sounds he's actually a couple of years younger than I am, but I knew Kari very well we had done deals together, and I actually worked for his father in banking. His father was my mentor when I started out in banking, so I knew him quite well. And what I did my first thing at Sampo was really to sort of appoint him my deputy CEO, which it took a little convincing with the board, but eventually I said, look, you have no say in this. It's sort of either we take Gary or I'm out of here. Gary is a very analytical. He's a very good negotiator. We are a very good negotiating team. We usually did this good cop, bad cop act. Gary was usually the bad cop, and he was sort of he was getting bored at always being the bad cop. But eventually, he got to play good cop a couple of times. He's really good. We're very complementary in many respects. He's more of an engineer in his approach to things, whereas I'm very financially driven. I mean, he's also good with finances, but we were just a very good duo in those sort of 10 years that we worked together in that setup. Then we worked another 10 when he was CEO, when I was chairman. Those years were not quite as spectacular because after the big financial crisis, the deal volume, of course, came down. So we didn't have as much fun in the 2010s as we had in the previous decade. He's a great guy.
Looking at all the M&A experience you have, do you have some M&A learnings that you'd like to share with leaders of today? What are the most important things when you're involved in
Well, I've already mentioned one,
yeah.
which is you should always be prepared to get up, so sort of just get up from the table. You should always be prepared to sort of break off and say, look, no, this makes no sense. I've seen so many times executives sitting at a table and then starting to receive more and more bad news from the seller. They sort of disclose one negative news item after the other, and to no consequence. With a buyer that just sits there, who's so convinced of the strategic rationale of the acquisition he's about to make, that he doesn't sort of react to all the negative news that's flowing in. You should always be prepared to sort of revisit your investment case, do the numbers, and if it changes for the worse, the least you should do is negotiate down the price. But perhaps you should also get up from the table and basically just say, thanks, I've had enough. So that's one thing. Another thing which I think is very important now, which I also mentioned in the memo, as I think it's very important from the onset of a negotiation to analyze and then ultimately make up your mind who owns the clock, i.e. who is in a bigger hurry. Because you need to negotiate completely differently if the clock is ticking more loudly on your side than it is on your opponent's or the other party's side. And that's really important, because if you can see that the opposing party is in a hurry, then of course you need to use that to your advantage. There are many other sort of things you should remember when acquiring companies. If I just mention something on the sort of human interest or executive interest side, you of course need to have not just a theoretical takeover plan. I mean, everybody has one of these plans with sort of based on financials, and then we do this and that. You need to have the people, and you need to be sure that the people who you pick to join you from the company that you acquire are good people, and that they are loyal people, and that you can incentivize them in a way which will actually make them work as part of the new whole.
A huge thank you to you, Nalle, Wahlroos, for sharing your insights. And of course, to you guys for tuning in. If you enjoyed this conversation, don't forget to check out our later episodes for more stories about Sampo's milestones. Thank you very much.